Assalamu alaikum everybody, and a very good morning to all. I see that quite many people have joined, and जितनी मेरी experience or knowledge है, I would take the most of the opportunity of it and try to impart as the best knowledge I have on TBML. Okay, so begin with, I would just be sharing my screen. Just a little to describe me on my background. I've worked mostly in 2 to 3 organizations, and currently I'm working with Deutsche Bank in the TBML department. I've previously worked with Banker Habib as well as Habib Bank Limited in the FI and trade and compliance departments. Basically, compliance is my main core function where I specialize in. Okay, so to begin with, I presume in this session there are many personnel, there are many people who are from the banking industry or from other industries as well. So here basically I would be most focusing on banking industry as well as the other sectors on different aspects. To begin with, बहुत सारे ऐसे लोग यहाँ पर मौजूद भी हैं who are more experienced and more learned than me, and I hope if I go wrong in somewhere they would apologize me or correct me in any sense. Thank you. To begin with, let's move on. So here we have the scope of what I'll be speaking of in this session. Okay, the first one I have here is the parties who are involved in the trade transaction. Just a brief introduction. Moving on, what is trade-based money laundering? Then how does trade-based money laundering work? What are the methods of it? What are the financial crimes associated in trade finance? Next, we have the challenges. Risk indicators. What are the red flags? A little introduction and brief description on the defense and dual use of goods. How do we control or how do we mitigate the risks based on trade-based money laundering? And something I would just have like to tell you a jinx about the framework that has been brought out by the State Bank of Pakistan in October 2019. So let's begin. First, we have the parties which are involved in the trade transactions. The core parties include the importer, which is obviously everybody knows the person who buys or imports the goods. Then we have the seller or the exporter, who's the person who is selling or exporting the goods. Then we come to trade facilitators. Who are the trade facilitators in any international or domestic trade transaction? There are carriers involved, which include air, land, sea, or mixed. These might be single mode of transportation or multimodal transportation. Then there is insurance company in between who handles the, we can say, gives the assurance or guarantees for any of the losses during the trade transaction. It also enables business to reduce the risk by protecting them from, we can say, from bankruptcy and instability as well. Then there are ports involved, customs involved, regulatory authorities involved. Customs, obviously, they check for all the applicable taxes and custom duties before the clearance is given by them. There are ports where obviously the goods are discharged and taken off. And there are regulatory authorities who ensure everything is being taken care of, is being properly handled as in place by the rules and regulations. Next, as we move on, we have the forwarders, freight forwarders, and the clearing agents. When we speak of freight forwarders, these are the personnel, or these are the companies who play a very basic role in trade. If they are not there, obviously, as an importer and exporter, they would have problems getting their goods transported to the port and getting them shipped abroad. So what do the freight forwarders do? They basically arrange the movement of goods from one place to the another, which may be from the buyer's point of the, which is the seller's point of discharge, to the buyer's point at his doorstep. So they all and the clearing agents also help you give you custom clearance about duties, etc. They also manage the damages and so on and so forth. Then we have the finance facilitators. Obviously, during an international trade, many a times it happens that the buyers and importers are not well aware of each other, or do not guarantee each other, or do not trust each other, basically, I would like to say. So what they do is they include a bank of themselves, a bank of theirs, which manages the trade transaction financially and take care of the international as well as domestic transaction. So here we have the buyer, which is a buyer chooses an importer bank himself. A seller also chooses a bank for himself. And then there are other connecting banks, which includes corresponding banks or the banks which have nostro accounts to deal with the financial transactions. So moving on, let's see what we have on trade-based money laundering. Okay, I would like to share a video with you. Just a minute.
Trade-based money laundering is one of the main ways criminals like traffickers, smugglers, and organised crime groups try to disguise and move the proceeds of their crimes. They also use trade-based money laundering to thwart sanctions, evade taxes and customs duties, avoid capital controls, or illegitimately claim tax incentives. The amounts these criminals can launder in this way are substantial, estimated to be at least many hundreds of billions of dollars each year. Unless action is taken, these figures are only going to increase. So why do these criminals use trade-based money laundering to move their ill-gotten gains? Well, firstly, as the financial system becomes a more hostile place for money launderers, trade is seen as an increasingly attractive option. Secondly, the scale, speed, and complexity of global trade, which is valued in the trillions, also makes it difficult to spot illicit transactions. The criminals are able to hide their activity in plain sight amongst the millions of containers of goods transported each week. So what does trade-based money laundering look like? Well, most of it seems just like legitimate trading activity, and so it's very hard to detect. The most popular techniques used are mispricing, which is where trade goods are invoiced above or below fair market value, submitting more than one invoice for the same transaction, over or understating the volume of goods traded, using a false description for the goods altogether, or making up phantom shipments that don't even exist. With no set prices for goods, and with value varying based on quality, quantity, and other commercial considerations, detecting illicit trade is a real challenge. This challenge is largely shouldered by customs authorities, law enforcement agencies, and banks. Banks which provide trade finance products contribute to the fight against trade-based money laundering by implementing risk-based controls. These include a robust customer due diligence process to ensure banks know their customers and their expected business and transaction patterns, as well as checking against sanctions and other watch lists. Surveillance and other controls designed to identify and investigate potential red flags or key risk indicators, and training and awareness programs for employees involved in processing trade finance transactions. But there's a limit to what banks can do. Partly because they're not involved in every trade transaction. In fact, banks provide traditional financing in no more than 20% of cases. They have such limited information about the underlying trade deal in the other 80% of transactions, which are called open account transactions, that detecting trade-based money laundering is virtually impossible. And where banks are involved, they have no opportunity to physically inspect actual goods or containers. With the possible exception of the importer and exporter, no one party in any trade activity has a complete view of the transaction. Without the full picture, identifying and preventing illicit trade is incredibly difficult. Some banks think this risk is too great and choose instead to stop offering trade finance products altogether, which can have a negative effect on legitimate trade. So what are banks doing? Well, of course, they should apply the lessons learned from fighting cash-based money laundering to better understand illicit trade. Using automated surveillance, which is one of the key anti-money laundering controls for cash, may increase effectiveness to some extent. But this isn't enough on its own. In fact, momentum across the industry is moving in favour of a more tailored approach. For example, banks could use potential red flags to better identify and categorise higher-risk customers. They're also looking at ways to harness risk-based intelligence, bringing together comprehensive customer knowledge, transaction information, and other meaningful risk factors. With the added boost of innovative technology, this intelligence could be turned into a powerful weapon for experienced analysts to use against illicit trade. This may also help banks to react faster to emerging trends in trade-based money laundering. But clearly, this isn't a problem banks can solve on their own. The Wolfsburg Group, the International Chamber of Commerce, and the Bankers Association for Finance and Trade made a number of recommendations in their 2017 Trade Finance Principles. One of these is to have greater collaboration between the private and public sectors. Let's think about what this new way of working could look like if all stakeholders, from shippers, airlines and truckers, port and custom authorities, to businesses, banks and law enforcement agencies, could find better ways of sharing information, then collectively they could do much more to disrupt these criminals. Just one example could involve each party contributing their limited information to a data pool to create a more complete picture. Customs authorities and law enforcement could then use this to find potentially suspicious transactions. Banks are ready to play their part and join forces with the public and private sectors in the fight against trade-based money laundering. Perhaps together we can turn the tide against illicit trade.
So I hope this video was quite beneficial for you, because it was beneficial for me. This video basically was brought out by, I found it on the website of Banking Association for Finance and Trade. And it's a very good video which gives you a brief insight of all what is included in trade-based money laundering. Okay, so let's proceed further. What is basically trade-based money laundering? A small and short definition: the aim of trade-based money laundering is not the movement of goods, but basically it's the movement of money which trade finance facilitate. So we all know that trade-based money laundering includes the movement of the illicit money via trade transactions. This is a definition which was brought out in 2006 by FATF. The process of disguising the proceeds of crime and moving the value through the use of trade transactions in an attempt to legitimize their illegal origin or finance their activities. So the money launderers, obviously they had a method of laundering money via cash or via other financial measures, but now they have found trade as a core factor for moving their illicit money from one place to another or getting it clean. So they are using trade transactions for this purpose. FATF has also provided a definition for terrorist financing by using trade, disguising the movement of value through the use of trade transactions in an attempt to finance terrorism, whether from legitimate or illegitimate resources. So FATF has put quite strength and quite importance on trade-based money laundering. So as we all know that basically there are three measures or three types of money laundering. So this is how money laundering takes place. It can be via trade, it can be via any other factor. So initially, there's the first stage of money laundering is placement, where all the dirty money from the illegal transactions is placed into the financial system. So how does it enter the financial system? Through trade-based money laundering, one of the main, we can say that it is famous, or we can say that it is the most used money laundering technique, which is over-invoicing. So what the money launderers do, they inflate the value of goods in trade transactions. Obviously, it creates an artificial profit, and that is entered into the foreign bank accounts or into the ledger financial system. The second stage of money laundering is layering, where you try to deviate or you try to move that illicit funds in so many places that it is that it becomes that it becomes difficult or impossible to get traced by the law enforcement agencies. Okay, now these ways include wire transfers to other countries via many resources. It can be from a bank account, it can be from a hawala, or it can be from any other resource. Then we have payment which are being made on false invoices by one person to the another. Then we have mislabeling of goods. Goods are not properly labeled. The thing which has to be sent is not sent, but something else is sent, which may be fake in that scenario. Then we have wire transfers to offshore banks from shell companies. Now, a shell company is that company which does not have the address, or the company is only on paper. It does not have a physical existence. So many wire transfers are done to offshore banks, and they are unable to trace because offshore companies and the countries which are tax havens, so they have means they least provide information when they are asked to. So the third stage of money laundering we have is integration. Now, when the dirty money is put into the system, it's moved from here and there by doing structural deposits and structural transactions via layering. Then in the end, the final stage, which is the integration, you when you have your money here, you purchase, you take it out of the financial system by purchasing luxury assets, investing into financial investments, and you reintroduce your laundered funds into the system as legitimate funds, which obviously becomes again very difficult for the law enforcement agencies to trace. So some of the examples of integration are: you purchase gems, you purchase high worth assets, you purchase artwork, for instance, you purchase life insurance policies. Obviously, when you put your money in them, it becomes difficult to trace again. So these are the three stages of money laundering. Now, how does TBML work? Just will show you a small example. So for instance, a company there's a company by the name of company A. The funds transferred from a shell company in Africa. So shell company obviously does not exist physically. So whenever you go to trace it, you won't be able to find it. So funds are transferred from a shell company in Africa to company A account. Company A account further remits the funds to individual A, citing is at advance of cash units purchases. So here, all the money coming, all the dirty money coming into the account from a shell company is used to buy cashew nuts. So obviously, the payment is made in advance. It becomes legit because it's coming from a bank account, and coming from a shell company, it becomes very difficult to trace. Then what individual A does, he partially retains a small amount and sends the remaining amount of the money to the original remitter. So like this, so this is how integration, placement, and layering goes on. Okay, so we have a question: how can we stop placement of illegal funds if we accept the bulk of cash for the payment of import transaction without any evidence of invoices? This question, okay. I basically would refer to take the questions in the end. We have the moderator who would help me take on the questions because I need to cover quite many topics and I'm trying to cover it as soon as possible. So then we have the TBML methods. We have under-invoicing, over-invoicing, under-shipment, over-shipment, phantom shipments, false reception of goods, multiple invoicing, and black market peso exchange, which is basically not here, but it is a very good way of laundering money. So I would just like to describe it in detail and give you an example. Okay, so now here, what is under-invoicing? So the basic difference between under-invoicing and over-invoicing is where the exporter transfers value to the importer, and in the over-invoicing, the exporter receives value from the importer. So I prefer that pictures are worth 1,000 words. I've just placed pictures in here so that it becomes easy to understand. So here, for example, you have $200,000 dirty cash, which has been obtained from illegal transactions or illegal work. So how do you launder this money to another country via under-invoicing? So a person buys 1,000 microwaves as $200 a piece, which becomes $200,000. So now what the exporter does, he makes invoices for $1,000 for 100 a piece, not 200 a piece, which becomes $100,000. Now these microwaves are shipped to the importer, where he has to pay only $100,000 and not $200,000. So he saves $100,000 and he sells the microwaves in the open market for $300,000. So so indirectly he gets from the exporter $100,000 of dirty money, and another $100,000 comes from those where he sells the microwaves in the open market. So this is one example of under-invoicing. Then we have the over-invoicing, which is the vice versa of under-invoicing. The buyer, the seller buys 100,000 microwaves at $200 a piece, but he invoices the importer for, which is double, 400,000 a piece, which makes him $400,000. So here we see that the importer has to pay more, but he gets less. So here the exporter is receiving more amount of money via the trade transaction. And in the previous, which was the under-invoicing, the importer is sending more money to the exporter via the trade transaction. Now we come to over and under shipment. Basically, over and under shipment is the misrepresentation of the quantity of goods. So this technique is basically where overstating and understating the quantity of goods. Obviously, something else is mentioned in the invoice and something else is mentioned on the other documents which are given in the trade transaction. Sorry. In over and under shipment, there is also a concept of phantom shipment where the trade transaction does not take place at all. False description of goods. Now in over and under shipment, we had where the technique was for misrepresentation of the quantity of goods. In the trade documents, it is told that for instance 10 products are being delivered, but actually 20 products or only 5 products are being delivered. So that's over and under shipment. Then we have false description of goods. Okay. False description of goods is basically a technique which involves the misrepresentation of the quality of goods. A simple explanation: if you are ordering something which is original, I guess a pair of shoes of a very good brand, for example, Adidas or Nike, and what you receive is a fake or a China product. So obviously this is false description of goods. You mentioned something where a transaction is taking place between a buyer and seller, but what happens is you tell the importer that you are getting this product, but what you send is something which is totally fake. So this is false description of goods. Next, we have multiple invoicing. Multiple invoicing is where in one transaction you send in multiple invoices so that you do not get the bank, or do not get the LEAs to identify what false money is being traded. So this is basically where money launderers justify multiple payments for the same shipment. Payments may originate from different financial institutions, adding to the complexity of the transactions, obviously. Okay, so what black market peso exchange? I believe many of you must have heard of this terminology and many of you mustn't have heard of this. So this is basically I could say an ingenious scheme where this basically takes place in Mexico and the Colombia, where the drug cartels, they try to repatriate money from the US. Now let's see how it happens. Okay, so there are drug cartels who send drugs in the United States, and they sell drugs and they get US dollars for their sellings. So now they want to move these US dollars to Mexico and Colombia. So let's see how this is done. So to launder the US dollars, what they do is they contact peso brokers. Now the currency of Mexico is peso, so Mexican pesos are to be transferred. So they contact a peso broker who deals in such kind of dealings, illegal dealings and transfers. So they contact an intermediary who's a peso broker. Now this peso broker takes the dirty US dollars and places them into the US financial system. And this is through structured deposits, which is a part of layering. So here layering is taking place through structured, this is a placement where it is going through the financial system. So structured deposit in banks or different types of cash purchases. So he used different types of different ways to place the money into the financial system. Now what the peso broker does, now he has placed into the financial system, but he needs to move the money to Mexico or Colombia. So what he does, he identifies or he finds a US exporter who is willing to send goods from the US to Mexico, and he also finds an importer, a Mexican importer, who is willing to buy goods from the US. So now what happens? The peso broker arranges US dollar payments for the exporter to ship goods to Mexico. Now the goods are shipped to Mexican importer, who gets the goods and sells them in pesos and reimburses peso broker, who then pays the criminal group in pesos. So now we see that the drug lords who are sitting in Mexico via this trade process get Mexican pesos or Colombian pesos illegally or legally. So now you see all through this transaction, the money has been turned from black to white. So this is also an example where black market peso exchange in illegal transactions you say on the back end of trade transaction takes place. So then we have financial crime risks in trade finance. Let's see what we have here: price discrepancy. Then there is volume discrepancy. Then we have quality discrepancy. Okay, let me try to explain you one by one so that we can get to know in brief what these are. Price discrepancy. Price discrepancy, I would like to say where you have a variation in price, or where there is a significant difference between the price which is mentioned in the invoice, and it is quite different from the market price for similar goods. For example, if you buy a good, or if you are buying oil, oil prices are easily mentioned on the internet, and they are easily available on every source. So for instance, if you're buying oil for $10, but you know that in the market is going on for $40, so obviously this is a red flag, or there's a financial crime, and you get to know that something wrong is happening. Then you have volume discrepancy. Volume discrepancy is basically the same as what I said, the misrepresentation of quantity of goods, which was over and under shipment. So this is also the same as volume discrepancy, which is also which is financial crime risk in trade finance. Then we have quality discrepancy. Quality discrepancy is the misrepresentation of quality of goods, where you say something that something would be exported or imported, but what you receive or what you send is something else. Then we have structural complexity. Structural complexity is basically the use of complex or convoluted trade structures, where where we see that a customer is doing a transaction in a certain way for a long period of time, and suddenly he changes the way of what he does things. He uses other trade factors, he uses other intermediaries, he uses companies which are not to be used. For instance, shell companies, or the funds that are transferred are not being transferred to the same beneficiary, or uh, to the same person who is importing the products, but they are going to someone who is in the tax haven, or who are in who has a shell company, or where it makes it difficult for the funds to be traced. Then we have lack of economic rationale. I would like to just just tell you a small example which I had come across. Um, there was a trade transaction where uh, there was flow of, there was a trade transaction, if I can recall. There was, yeah, Pakistan was basically importing a certain amount of cotton from Afghanistan. Okay, now here comes a red flag. Like, why would Afghanistan being exporting cotton when it does not have that good to be grown in that country? But upon deep diving and after investigation, we came to know that the government given Afghanistan a certain amount of place, and it was specially funded by the government to for optimum utilization to grow a certain amount of cotton and export them. So it was obviously a very rare transaction which had come in our look, but after quite many a good EDD, we came to know that the transaction was legit. So obviously there are many transactions which lack economic rationale. It does not make sense that why this transaction is happening. But obviously for these certain type of transactions, you need to properly deep dive through the transactions and see if if they are legit or not, if there is a red flag or not. Uh, Transactions happening in political or economic instability countries are obviously not good, where these are places where you can hide the money easily, because there are fundings which are going on for the political or economic instability for different countries. Then we have suspicious financial behavior. Here, sorry, there are parties involved which have a for instance, you involve certain individuals or certain companies which could have a history of suspicious financial behaviors, for instance, terrorist financing, money laundering, corruption, and whatnot. So these are some of the financial risk in trade finance. Next, we have what are the TBML challenges? So lack of data and information sharing. Okay, I need to move on a little because I have 20 to 25 minutes. Lack of information and data sharing. Obviously, I will be just briefing you about State Bank, what the State Bank of Pakistan has said in its framework. It has given out its guidelines to maintain a trade KYC, which includes all the detailed information about the customer who would be performing trade transactions with the bank. So providing not appropriate data or lacking data is also TBML challenge, where obviously TBML cannot be opted if proper data is not shared. Then we have inadequate technology. We see that many organizations are still performing their TBML tasks manually. It has also been said in the TBML framework for uh, technology that develop. I would just recall an exact quote. I would just tell you that it has said that develop mechanism supported by technology-based solutions to carry out the assessment of prices. So for price variance, which I just explained in my previous slides, that for pricing mechanism also they have the State Bank of Pakistan has said to implement technology-based systems for the pricing mechanism. So there are various systems which have been taken up by many banks and organizations. Some are still on the verge of taking it. It might be transaction monitoring, it might be sanction screening, it might be um catching the whereabouts of the vessels using different softwares. Then we have what are the goods? Are the goods legit? Are they fake? Are they being used? Are they not dual use of goods, which I'll be describing ahead? Then limited knowledge and awareness. Obviously, proper trainings, proper awareness should be given to the customers for how TBML is uh, being done in the open market, and training should also be done to the personnel in the organization so that they have a good knowledge about how to identify and detect it. Then we have document verification. Many in the trade transactions, there are many times where you get false bill of ladings and other uh, transaction documents which are not legit. They are fake. Obviously, document scrutiny and document verification is very important and needs proper training and needs proper vigilance to identify trade-based money laundering. So then we move on with a few of the red flags. Now, what are red flags? There are basically many red flags. As per the framework set out by State Bank of Pakistan, there are, if I'm not wrong, there are 25 red flags spread out. I would just be describing, or I would just be discussing a few. Discrepancies between invoices and official documents. As I just said, something, for example, the name of the product mentioned on the invoice, it might be the name of the product, it might be the quantity, it might be the unit of measurement, it might be the actual unit price, or even it might be the weight of the product that is being sent might be different from the other documents that are being provided in the trade transaction, which include the bill of lading, or it might be the purchase order. So then we have unusual trade patterns. Obviously, the transaction will deviate from their normal or usual trade patterns, such as making round amount payments. Then there are inconsistent product types, or using shipment routes which are different from what they have been using before, in order to avoid the original owner of funds. Then we have routed through multiple countries. What the money launderers do, instead of just picking up a route from one country to another, where that this where you know geographically that a trade transaction is possible from going from country A to country B directly, but in a trade transaction you see that it is taking more than 2 or 3 countries to perform the transaction. It becomes a red flag. You know that why is this transaction being placed in such a way that it is using more than a country. Then we have high risk goods. Obviously, there are various high risk goods which are included, or which are obviously these goods are high risk in nature. For example, if you have a person dealing in real estate or high value assets such as precious metals, it could be gems, it could be any other high risk good which could involve um, or which could raise a red flag. And high risk codes also involve defense induced use of code, which I would be describing with you further in these slides. Uh, Moving on, we have high risk countries. FATF has defined out a list of jurisdictions under increased monitoring. Its latest was brought out, if I'm not wrong, it had been brought out on 23rd of June this year, and it has 26 countries in it. Pakistan has been removed from that uh, quite recently. So there are special high risk transactions which raise a red flag and in which enhanced due diligence and thorough deep diving is required on those transactions which include these red flags. Then we have goods that are not in line with the exporters and importers business activities. Um, I would like to give you an example. Okay, I'll just tell you what the red flags are, and I would give you 2 to 3 examples, which would not only include one red flag, but 2 to 3 red flags. Then we have suspicious payment methods or cash methods. Okay, cash payments are mostly done by the trade based money launderers or normal money launderers, because cash payments are mostly not traceable. So they take the specific advantage of doing it. Then there is suspicious payment methods where payments are being done. For instance, we had received there was an example I went through where there was a good which was being exported, from by Yemen, and the payment was being made from Dubai. So upon deep diving, we came to know that Yemen, obviously, it has political and economic turmoil, and financial uh, systems of the banks are of making financial payments from there is a very difficult task for the importer. So what they do is they tell their subsidiary companies, or they tell their related companies to make payments. So the payment that we were receiving was from Dubai, and it was a little risky. So when we came to know that they had their subsidiary company in Dubai, so who are making payments from there. So these are the sort of transactions which people do come across uh, in trade transactions, where people try to and there are also ways in these ways where people try to launder money via trade transactions. Then there are third party payments. Obviously the companies, the importers themselves do not make payment themselves, sorry, but they um, make their payments from other third party payments of third party companies, which I would say is quite a red flag. Then there are frequent document changes. I would like to also quote you an example of a trade transaction which I just came across. Um, a company was importing, I guess it was some sort of goods. I don't exactly remember what goods were they, but they were being imported from, they were being exported to Saudi Arabia. But at the last moment, the bank received instructions from the um, exporter, from the importer, that they would like their goods not to be shipped to them, but to one of their customers in Sudan. So obviously Sudan is a sanctioned country. and it's also mentioned in the FATF list as well as other regulatory bodies. So Sudan is obviously a high risk country, and it's not permitted, and it's not permitted basically to do it over there. So it was a request made to them that we would not be shipping goods to them. So yes, for this, so like, after properly investigating, and it was like the importer said, okay, fine, do not send it to Sudan, send it to me. So this is a type of red flag. Like at the end moment, the importer or the exporter, whoever, might make their changes in their payments uh, to hide what they are doing. They do not want to either send the original goods, or they want to hide the trace of their funds moving or sending their goods not to the original country but to the fake company in another country. So then we have a transaction with no economic sense. I would like to give you another example where a company was importing, a textile company was uh, there was a textile company who was basically importing and exporting textile products related on and off. But once it suddenly imported coal. Okay, so this was a suspicious transaction. Now here, this is an example where transaction makes no sense, no economic sense. So what we did is as a due diligence, we asked them why are they importing coal. So we came to know that coal is being imported because they are generating their own electricity, and they needed coal because the coal that they are importing was of a special sort, and it created a special type of smoke which was required in generating electricity in that particular machine, or in that particular what do you call, the power generation machine. So we require enhanced due diligence when we receive such transactions which do not make economic sense. Obviously, they might be legit transactions, but you need to dive in further. You need to investigate. You need to conduct proper due diligence of what the transaction basically is. Then there is use of front or shell companies and complex structures in transactions, which need to be taken care of. So here we have defense and dual use of goods. Now, what are they? Now, these are goods. Okay, I'll just read out the definition. Dual use items are goods, software, or technology, which can be used for both civil and military purposes. These are goods which can be used for both either civil or military purposes. Now, these are some of the examples. Fire retardants. These are basically fabric or substance which is used for preventing fire. Now, the construction. Now, these can be used either in the construction industry or manufacture poison gas. Then there are computer software, there are computers, or there are software related, which can be used either in the home for office use, or these can be also used in the electronic or mechanical component, which can be used for the manufacture for technological equipment or for making missiles either. Then viral strains. Okay, for example, Ebola virus, we all have heard of. Okay, now these are used basically for the viral strains are used for either if we use for civil purposes, these are used for medical research. But if we see in the aspect of military purposes, these are used for biological weapons. Then there are many chemical products which are used for either in the labs, they are used for industrial purposes, but on the opposite hand, these are used for chemical weapons as well. Then there are various machine tools, equipments, and equipment tools, which are used in the conventional industry to make various things, but on the other hand, they can also be used in the uh, nuclear field to make various nuclear weapons. So these are some of the controls for defense and use of goods. We have screening transactions or goods which can be uh, screened via the UK Strategic Export Control List. This is the website. So you can go there. It's if you write on the Google, like Google would obviously give you the response for when you just type UK Strategic Export Control List, and it gives you the response. And then we have a strategic export control division, which is the SECDIV. Obviously, in order to save ourselves from the proliferation of weapon of mass destruction, which basically poses a threat to the international peace and security. So in response to the Export Control Act of 2004, the SEC DIV was set up in 2007, and as per the laws of the Ministry of Foreign Affairs to administer um, export controls. Um, this the there was a list made there was a list made in which all the goods which were dual use in nature were added to the list. So it could be used in order to prevent from the weapons of it could help in the proliferation of weapons of mass destruction. And the category, just to give you an idea, this is how the category has been made for the defense and dual use of goods. Okay, so how do you mitigate TBML risk? A vigilant and proper KYC should be maintained, and it should be properly reviewed yearly, 2 years, or even driven. Then a customer due diligence properly, it must be in place, and it should be performed with every customer. Enhanced due diligence should be performed for every, I believe, high risk transaction or every high risk customer and or due diligence, whichever and wherever it is deemed necessary. Then there is transaction monitoring. Transaction monitoring is basically the post transaction control, where different softwares bring out I would say there are various trade scenarios which bring out transactions, which bring out alerts which are to be closed properly. Proper due diligence to be conducted, and then they should be closed. Then we have release of goods, which has just been explained. Then suspicious activity reporting and suspicious transaction reporting. This is where a financial transaction, wherever they suspect a transaction or a pattern of transaction that involves MLTF or any other illegal activity, it should be reported. And it has also been set out in the framework spread out by State Bank of Pakistan that a bank may evaluate the transaction for filing an STR with the financial monitoring unit if they have sufficient grounds to form suspicion over a transaction that is to be made, or which there's a suspicion of money is being laundered. So SBP has also given quite emphasis on raising STRs and SARs. Then screening is to be performed on the individuals, might it be the entities, the vessels, the goods, the destination, via different screening softwares. Then adverse media search or negative media search also helps in mitigating TBML risk, where you get proper news and different articles on the customers or whoever it may be, if they have done anything suspicious or legal in the past. Then price verification, as I explained before, is also a very important task, where you properly identify and monitor if the price is being variant or if it's deviating from what is being traded into the market. Then there is voyage check, which includes shipment existence and shipment route. Now here we have the International Maritime Organization number for every vessel. There is www.marinetraffic.com, where you can just put the IMO number or the name of the vessel, and it would give you where the exact location of the vessel is. And in order to identify the shipping route, uh, which would be to avoid sanctions or the shipment existence, if that vessel or ship does exist, to avoid fraud, there is the Lloyd's intelligence report, where you can where you have to subscribe, or there is a particular amount of money for every report you generate from them. You can have the quite a long history of where the vessel has been, or how many sanctioned countries it had been stopped upon or docked upon. Then we have, okay, then moving further, these were some of the TBML controls, but obviously there are various others. I have just mentioned a few which I have thought most important to be. Then this is a little bit about this State Bank of framework, what they have told in their um, framework. It was, as I just said, it had been taken out on October 14, 2019. The major point that were discussed in the framework is risk profiling, where a proper trade KYC and undertaken is to be taken from the customers before a trade customer is onboarded. Price related due diligence, sorry, high risk transactions and hand diligence is to be done. What are the high risk transactions? Development and maintenance of goods. A brief a brief like, I won't say a brief, it had been also like State Bank of Pakistan has also mentioned something on transaction monitoring regarding the trade scenarios to be implemented in their softwares. Sorry. Then there is training and assessment, how training should be given, what training should be given, and what are the domains on training, on those domains what training should be given. Then the collaboration with stakeholders such as customs, shipping companies, to make the transactions easier. Okay, now this is a little on, last but not the least, this is a little on undertaking and trade KYC. Obviously, before onboarding a trade customer, every bank needs to sign a letter of undertaking from the customer, which includes which accounts they are maintaining, which trade accounts they are maintaining from the other banks, and how much overdues it might be, either import or it might be either export. So after having that letter of undertaking, you come to know, you can calculate a certain amount of risk on that customer with related to the outstanding dues they have with other um, organizations, other financial organizations. Then there is a trade KYC which has to be maintained with every customer, which includes the goods and services. This I was talking about, like, if you have a proper information, and if you have sufficient information in your trade KYC, you there is a very better option that you can identify and mitigate trade-based money laundering. So in the trade KYC, you need to properly get the information on the goods and services that the customer would be trading in, who are the buyers and sellers, what is the annual volume of the trade transactions, uh, what are the country of origin of goods that the customer would be importing from, what are the countries of business he would be dealing from. This is where you get to know if it is a high risk country or a sanctioned country. Then what would be the port of loading or discharge, what would be the mode of payments, who are the UBOs, what is the legal structure of the customer, is it licensed, is it legal, is it not legal. So this was something, I would say, what I had to say on trade-based money laundering. So this is all from my side. With restraint to time, I've taken 6 minutes more. So if there are any questions, I would like to spare with a few, 2 to 3. And if I'm unable to answer, I'm extremely sorry. I would definitely have some research on it and respond it to you later. Or I would give it to the moderator.
Assalamualaikum. Thank you so much, Salman. It was truly a very brief and very informative presentation, and I hope many things have been cleared for which we were not exactly knowing what actually we need to do. So I would like the participants, if you need to ask something, do write it now, or otherwise, please you may ask the questions on the WhatsApp groups, and Abbas will coordinate with Salman accordingly, and will arrange to answer you uh, as soon as possible.
Assalamualaikum.
Islam.
I would like to ask a question about trade-based money laundering chain.
Okay, sure.
How can we neglect that trade-based transaction if we are getting a cash deposit in a bulk in banks without any invoices and proof, and then make payments abroad for import transactions? It's my first question.
Okay.
And my second
Okay,
question.
let me get you with the first question. Basically, for this, you need to have a look on the source of funds and the source of wealth. So, like, you need to have a history. You need to look at the chain of the mode of payments the customer is being using. Obviously, as I said, cash transactions, a customer making cash transaction is very difficult for you to trace it. So for instance, a customer or a person comes, or a person of the an employee of the customer just turns in and makes you a payment for a certain trade transaction, obviously, which is unable to trace. But you need to have a view of what other mode of payments he's been using, or the cash that is coming in. You may have a view on it, or like, you have the CNICs. You can screen that particular person which is being done by this screening unit of, is that person legit who is coming to screening, because there are various attempts where a person who is not working in the organization, or it is just a layman who just turns in and makes the deposit for that particular trade transaction. So here I would say that source of wealth should be checked, source of wealth should be checked, previous modes of payment should be checked. What is basically, how would you identify, and how would you mitigate the TBML, such TBML risks? Now your second question, please.
Abbas, please allow that gentleman to ask the second question.
Thank you, sir. My second question is how can we mitigate such things in trade-based money laundering in a local matter? We have a lot of customers who are trading in local, buy goods, sell them, but we don't have any their counterparty details from whom they are purchasing goods, and from whom they pay for the goods. We don't have any large amount of data.
Like,
How can they generate their source?
so this is the thing that State Bank has brought out the trade KYC. You need to know, or you need to have the exact amount of information of your customer. A proper customer due diligence need to be maintained. A proper EDD needs to be maintained if it's a high risk customer. You need to know about their customers. You need to about their goods, what they would be trading in. Obviously, if if you have a company who's like, there has been a huge there has been latest information. I'm not exactly aware of it, but on the solar panels, it is huge in demand now. So obviously, a person who's dealing in solar panels, for instance, suddenly decides to deal in textile. So obviously, this is a huge red flag. You cannot know what the person is doing. So you need to have proper information on proper due diligence on the customer, which includes goods, its whereabouts, where he is importing the goods from, where he is exporting the goods from.
Thank you. My last final question is about the technology we are using for the combating of trade-based money laundering, because it is very difficult to catch him if we have a differences between GD invoices and declared value of invoices and invoices, but there is no red flag generated for that. In State Bank policy, we don't have find any red flags in different between the invoice value and GD declared value, product name differences, on product quantity differences and their unit of measurements. So how can State Bank apply such measures to different banks to mitigate their risks?
Okay, to mitigate the risks, different organizations, have made their own policies and procedures to mitigate their risks. State Bank, if you read in the framework, State Bank has brought out the way to mitigate risks. Every bank has their risk tolerance percentage to mitigate the risk. Obviously, if you see in the custom GD, there is an assessed and there is a declared value. Customs assess a value from their end, and the amount in the invoice is your declared value. So obviously, when you are assessing both the amounts, so you need, if you find a difference, you need to get it verified, or you need to get it checked from the business team or the invoice team, that why there is a difference. In addition, you may also conduct proper due diligence from the price verification team. If the price that is being or what the price is mentioned in the invoice, is that being uh, concluded, or is that does that coordinate with the price in the market? So there are certain controls which a bank itself takes in its place.
Another one is that there's a lot of difference between the HS codes. Different HS codes are used in the commercial invoices, but the FI generate which is presented to the custom are totally differences. But the banks don't have any kind of software who can detect it on urgent basis, and transactions that go through and payments are made to the broad.
Okay, here every country, okay, some countries do not have they do not take importance on the HS codes at all. They just have their goods. Some countries like us, we have certain HS codes, or many other countries which do have HS code for their products are different. Okay, so if you match their HS codes with our HS codes, it does not match. So on
even they are not matching with our invoices.
Exactly. They do not.
Invoices are different, and GDs are printed by the customs authority are also different.
Yes,
A lot
because
of differences, we have
yes,
no software to detect it.
there are certain softwares which do detect their HS codes as well and our HS codes as well, and you have to go, because the HS codes which have been laid out in the customs declaration, okay, or in the goods declaration, are Pakistani HS code. But obviously, if you are importing a product from Cyprus, for example, or if you are importing a product from China, the HS code would be what is mentioned in what means the goods which are being made in China are according to their HS codes. So these are quite different, and there are softwares, there are technology-based products which have or which are detecting HS codes which are based on the other countries as well.
So State Bank of Pakistan reduced FI only for the misrepresentation of the data, but custom can release goods without checking that the FI generated for the transaction have different HS code. Custom should stop it and allow the bank to change the accurate HS code if they are allowing the goods to the importer to leave.
That I can do if I work in the customs or if I have some contact in the customs.
Yeah, I only just suggest for the
Yeah, obviously it's a very good suggestion. There are many things, obviously, which I have previously come about, like, which we think that should be corrected in the customs, because there are certain products, there are certain HS codes, there are many things which we think that it should be in this way and it should not be in this way. So obviously there are many recommendations which should be brought out. This can only happen if the banks have proper coordination, or they're in collaboration with customs and other government related bodies.
Thank you,
Uh,
sir, for your
I
great
would
time. Thank you so
I
You're
much.
would
welcome.
like to add. I would like to add one thing, that anomalies can happen. The other thing is, transaction monitoring is the secondary thing. What we need to do is the customers KYC. If we have proper customers KYC in hand, beforehand we know everything. So I don't think there can be a large variation in the transactions. Salman.
Exactly, absolutely. Trade
Thank you,
KYC,
sir.
basically, you're
Thank
welcome. Just one thing, most important, because I've been personally working on the trade KYC myself. So I know if you have proper and sufficient information regarding this employee, my friend just asked me regarding the HS codes. So obviously, when you have a certain amount, if in the trade KYC, if you know what the goods your customer would be trading in, the HS codes of them. So you have, obviously he won't be using 500 to 1,000 products. He will be dealing in a certain products, and in that certain products you have those certain HS codes. So you don't need to have, you won't be calling, or you won't be moving here and around, or your transactions won't be delaying much. So the more information you have on the KYC, as said by Mr. Abbas, so the more efficiently and the more smoothly you would be processing your transactions. So I guess we have, is there any other question, or you can just write down your question and give it to the moderator, and they could pass on me and I could reply you later on.
Thank you so much, Salman, for the great session.
Oh, you're most welcome.
Okay, so we are going to sign off for today. Thank you so much, participants. Once again, Salman, thank you so much. And inshallah, we'll be in touch with you,
You're
and
welcome.
we'll take this accordingly. And it would be great, an honor for us to have you on this forum. Thank you.
You're welcome. Thank you so much.
Thank you. Take care.
Thank you, participants, for attending my session. Appreciate it. Thank you.